Hi, everyone. Thank you for joining us for the fifth session of Cherry Bekaert's 2022 Professional Services Virtual Conference Series. My name is Scott Duda. I'm a partner and the leader of Cherry Bekaert's Professional Services Industry Group. Our virtual conference series is designed to provide quality, industry-specific CPE at convenient times, all free of charge. We're offering general sessions for all professional services firms, as well as sessions specific to A&E firms, law firms, and financial services firms. We hope you're able to join us for next week's continuing virtual series. Please visit the link in the chat to register for the remaining session. A couple of notes before we get started today. To receive CPE credit, you must answer at least 3 polling questions and attend for the full 50-minute session. CPE certificates will be issued via email within 10 days. If you've not received yours after 10 days, please email cbhlearning@cbh.com. A recorded version of this webinar will be available in about 1 week and will be sent via email and posted to our website as well. If you have any questions during the webinar, please type them into the Q&A window located in your control panel, and we'll be monitoring that throughout the session. And then another note, a short survey will be posted at the conclusion of the webinar. We value your feedback and ask that you please take part. Now, I'd like to introduce today's speakers. Mike Dempsey, Financial Services Lead in Risk and Accounting Advisory Services with Cherry Bekaert, along with John Eckert, Regulatory Advisor with Cherry Bekaert's Risk Management Solutions Group. Please, Mike, take it away.
Thanks, Scott. A little background on me. Welcome, everybody. Lunch hour here. Spent 22 years so far in risk management since my days at Credit Suisse First Boston, again, 22 years ago, when third-party risk management was not even a name or a discipline. It was called outsourcing or supplier management. It was usually buried under an IT function. When I was with the Federal Reserve over 12 plus years ago, when I first met John, we started to see the transition from supplier vendor management outsourcing to third-party risk management. John himself worked very closely on the Interagency Guidance OCC 2013-29 in his OCC policy supervisor role. And we've seen third-party risk management in the top 5 of regulatory supervisory priorities for the last 10 years. So we'll have fun during the next hour talking about vendors, suppliers, and third parties and what it means to your institution or company. Anything to add, John?
Michael, thank you. Just for the group today, yes, as Mike said, I spent a wonderful career with the OCC over 30 years, everywhere from the smallest community banks in the nation all the way up to the megas. Third-party risk management definitely was my main focus when I was with the Office of the Comptroller of Currency at Washington, D.C. headquarters. Thought when I retired, I thought, okay, that's it. I'm just going to take it easy. Well, third-party risk management continues to be in my bloodstream, and I'm still being involved today with dealing directly with clients, advising with third-party risk management. Really just the full coverage, helping from the point of due diligence all the way through to ongoing monitoring and all the governance aspects, which we will cover today. And so with that, Mike, I'll let you take it away.
Thanks. John and I have worked together about 12 years, and I think we can rehearse each other's sentences or finish each other's sentences by now, since we've been having these same chats year to year over 12 plus years. But the first question we always get is, what is a third-party relationship? And it's very simply defined as any business arrangement between one company and another by a contract or otherwise. And then the question is, what is third-party risk management? You throw that TPRM acronym in there. Obviously, the idea is, although an organization can reassign a service or outsource it to a third party, you can't outsource the associated responsibility for managing the risks, right? The regulatory requirements. So ownership and accountability still lies with the institution. So, and again, the act of integrating a third party to your organization can create additional risks. Could be country risk if you have offshore vendors, concentration risk if you have one supplier, that obviously from a criticality perspective. So really, third-party risk management is the process of identifying, monitoring, and managing third-party risks, just like ERM. Again, obviously third-party risk applies not just to vendors, but suppliers. It could be internal affiliates. We can cover that in the Q&A. I know there'll be a question or two about affiliates. How do you treat affiliates? Joint ventures, strategic alliances. There's a lot of stuff that falls under that category. So having an inventory of vendors really is not enough. You need to inventory all of your third parties. I was working with a client yesterday from a community bank up north that utilizes third-party payment processors. They're called TPPPs. That's quite an acronym, which obviously poses high risks with AML and BSA. And I also want to mention fourth parties. We talked about subcontractors. Are these identified during onboarding due diligence? Very high risk with fourth parties. So a lot of skeletons can be buried there. So John, anything to add there?
Yeah, I'm going to add, with the proposed interagency guidance that maybe hoping, fingers crossed, will come out in our lifetime, fourth parties are specifically noted in that proposed guidance. So my expectation is we will probably see some language around fourth party treatment in the new interagency guidance. So hopefully, like I said, will come out soon, but that has been a topic I know within the industry and now also being addressed by the regulators. And that interagency guidance would be the Fed, FDIC, and the OCC.
I'll also say that fourth parties, you could have fifth parties or sixth parties. I've seen that layering down as much as, and that's what scares me. So all right, I think we got our first polling question, and our first polling question for CPE purposes is, what does your organization call its third-party risk management program? 4 choices. One is either vendor management, VMO, vendor management office. B would be supply chain procurement. C would be TPRM, and D would be other. Give a minute to get all the questions here. Interesting. Okay, looks like we're split between vendor management, which I wasn't that surprised about that answer, and other would fall into. So I'm curious what the other category, what choices, and you could even put them in the chat box if you feel inclined. Very curious just for our knowledge, just to see what you're on that. But one thing I'll say about that is vendor management should be aligned under the risk management organization traditionally and broadened to include third parties. It really should be a hub and spokes model, as I would call it, across business owners and support partners. So support partners to me would be your info security, compliance, legal, business continuity, privacy, as well as a clear definition of board responsibilities. The board has to have oversight over your third-party risk management program. So what we expect to see is a report that goes to the board on an annual basis saying, here's the third party, the current state of affairs, your critical vendors and your critical risks with third parties. So again, I've seen vendor management under compliance occasionally, but then the perception becomes that it's a regulatory check the box exercise. Anything to add there, John? That's one of your favorite topics, is avoiding the regulatory check the box.
Yeah, definitely. And, I'm glad to see that in August of last year, you saw the agencies come out with the due diligence to fintech, the financial technology firms, and definitely bringing up the 6 factors that are already included in the other regulatory guidance. So something definitely, when you talk about resilience, Mike, that's definitely one of the key due diligence factors.
Agreed. And I think distributed accountability is really key across what we call the 3 lines of defense. If you've ever taken an ERM seminar, enterprise risk, or heard me speak, we talk a lot about the 3 lines of defense. Third line, internal audits. Second line would be that TPRM, vendor management office. First line is the frontline owners, contract owners, relationship owners. So that first line concept is very key. You also need a roadmap for your program commensurate with your culture, size, and complexity. So if you're, for example, if you're looking at banks, if you're a small community bank, you don't need a program looking like Bank of America, right? So you got to make the program, the roadmap commensurate with the culture, complexity of your organization. You look at your contracts, your procurement process, the sourcing strategy, cyber involvement, cybersecurity regarding penetration testing for your new vendors, fraud monitoring. Really what we get here is an integrated approach is needed. And, if you look in general, third-party incidents are disrupting our companies and reputation a lot in the last number of years and there's limited resources for the second line. So you really need that front line, first line ownership. You also need to build resiliency. You've heard that term through COVID, throughout, in third parties. Resilience planning should really be closely coordinated with third-party service providers. So establishing well-defined expectations with third-party service providers is really key for business resilience. Contracts, SLA, service level agreements with third-party service providers should detail roles and responsibilities of each party to promote resilience. And so one of the things on the slide is, why is there an increased focus on third-party risk management? Well, think about the last couple of years in general with COVID, but just in general, a greater use of third parties by business and increased velocity of risk events, which is again the COVID-19, due to increased usage of virtual work setting during the pandemic, requires more clarity of roles and responsibilities in TPRM. And then the other question I get all the time is, isn't third-party risk the job of the ERM? No, ERM is a stakeholder in coordinating third-party risk and obviously the policies, the oversight, but responsibility for initial and ongoing risk management should be shared, distributed throughout the organization. Really frontline, those contract relationship owners need to understand their roles and responsibilities. This way, risks are monitored by the individuals with the right subject matter expertise. And I'll get to my favorite topic, challenges. You know, third-party risk management is a journey, a long-term roadmap. You can't do a big bang approach, 3 months, 6 months. To have an effective and sustainable program requires a clear operating model, integrated approach training you need to do, like we're doing today. That requires coordination across the 3 lines of defense and clear ownership and accountability at each step. Anything to add, John?
Yeah, Mike, I think you hit it pretty well. When you talk about the top risks that are out there today, of course, as you mentioned, cyber and fraud, definitely they're always in the forefront. That we see in industry publications, concerns by regulators, in that that arena. But also, what's key is, and I think you brought up, was your points on contract management and compliance. How often contracts are entered into and then put to the side and really not integrated into an effective monitoring program. So there's challenges along the entire third-party life cycle, which you've laid out here in the graphic very well.
You brought up a good point, John. Ongoing monitoring. A lot of folks think once you do your initial due diligence, your onboarding, you're done. That's not the case. So if you're not doing annual or more frequent checks on your critical third parties, obviously having a scorecard to monitor their performance, you have an SLA, service level agreement. They're not performing, you better think about why they're not performing. Root cause analysis I would do, and I would also go back and make sure that there's contingency planning involved too, right, John? We see a lot of banks that don't have a critical supplier, critical vendor. They don't have a backup plan. If there's a problem there, they're not performing, or something happens, it could be a business continuity event, they have a very big challenge. So contracts are very critical. There are obviously clauses that are required to be in the contract, like right to audit, a lot of other things in there, but those contracts are really something you need to monitor on a really more frequent basis with your, and I think it's really the relationship owner, contract owner's responsibility to make sure everything that was set in stone during the contract is operating effectively. Otherwise, you could have a lot of problems. So.
Oh, definitely, especially, in ongoing monitoring, all the factors to look at with your vendor activity. But you're right. How closely are you looking to make sure that your third party is abiding by contract terms? And in some cases, what we've seen is, what is your institution doing to ensure that you are complying with the contract terms? In some cases, we've seen that where actually a third party can terminate the relationship in a contract because of the financial institution failing to take appropriate action on events, primarily cyber.
Yeah. The other thing's financials too. You mentioned financials too. Like a lot of time there's, you got to have that in your assessment. A lot of factors that go into your planning, your due diligence, and your obviously your ongoing monitoring. And that includes obviously looking at risk management controls, that third party, the financials, obviously reputational risk, obviously social media. that's something we didn't think about, right, John? Like 5, 10 years ago, Facebook or with Twitter.
Oh, yeah.
What are my kids?
Well,
My
one
kids
there.
are on. Yeah, my kids are on Snapchat or whatever. But a lot of these organizations, you have a third party, and there's an event that happens, and it's all over the social media channels. That could really disrupt your organization as well. So that's something that definitely is very recent from the time I started looking at TPRM 12 years ago, and now you have to think about social media. So,
And that's a good point, Mike, because of the fact, looking at, the life cycle here is offboarding. And one thing we always brought up was when you begin your planning process, part of the planning process is what do we do if either we have is it going to be a process we're going to end the relationship at a certain point? When you offboard them, what are you going to do? Are you bringing it in-house? Is there another plan involved? Or is there also, when you talk about resiliency, what happens if you have to offboard a vendor because of events happening that you're seeing on social media? And then again, what's your plan? How are you going to continue that activity if you offboard a third party? Again, do you bring it in-house? Are you looking for, or do you have another third party in line? Again, part of the resilience factor of continuing that activity.
Yeah, that offboarding is a great topic because I know it's on this slide. It's covered on this actually wheel that we're looking at right now. But do you have a termination, what I call checklist? When you have terminated vendor on either side, it could be your side, their side, it should be really what I call a root cause analysis done as to why. So to me, that checklist is very critical. One page doesn't have to be like War and Peace, but I think you need to have that checklist to understand the cause for it and make sure that these kind of events don't happen again. That could be a third party related incident that's not captured. It can happen a second or a third time. So that's typically ERM lingo that I'm using, but I think it applies very well to third party risk management. But this slide too, when you look at governance, we're thinking of governance in terms of policies, procedures, strategy. Is there a third-party risk management mission strategy set up? Do you have a risk appetite? A lot of banks don't have risk appetite really refined to cover third-party risks. I talked earlier about board reporting. Do you have board oversight? How well does the board oversee third-party risks? Is there a report done annually, as I said earlier? Do you have an inventory of all your third parties, or is it incomplete? That all falls under this wheel. So end-to-end life cycle is really critical. I mean, the first point I make on the slide is 3 lines of defense model. You have to develop that 3-line defense model. Obviously internal audit has their role, as internal audit always does, right? To look at it on an annual basis would be my thing, given the third-party risk management process in every firm is inherently very risky. If it's done less than once a year, I'd really question the audit risk ranking methodology, quite frankly. And then second line defense has to have that board, that kind of program oversight model. Again, the second line in the beginning of a program might be doing some of the first line's job, but over time, second line should stay in their box and first line should be doing their job, which is really managing the relationship with the third party. So you need to have a process, risk-based approach for assessing a third-party services tied to your risk appetite. And you got to do risk assessment and due diligence prior to the contract, not after. That's the most important point of this whole presentation. You got to do all these due diligence and risk assessments prior to going. You don't want to have a third-party contract and find out later that there were things missed in the initial assessment. That could be very catastrophic. So again, going through this life cycle, you see a lot of areas covered here. You got your risk assessment, due diligence, you got risk acceptance when you have a third party that may have some outliers, things that you may need to accept in the course of doing business. I would call it BAU, business as usual. You got the contracting piece, which you got to have your legal folks involved in doing. And then again, ongoing monitoring is really critical. If you're not doing those scorecarding for critical vendors, you're going to miss something along the way. And then really have that mitigation plan to attack things that are not going well. It's constant, continual monitoring, in my opinion, ongoing third-party portfolio, looking at the portfolio for concentration risk. You have everything, and John has seen this in his past too. A lot of organizations have a lot of critical activities with one vendor, and if something goes wrong, they don't have that contingency plan. That could be a really bad thing going on there. So, John, anything to add on that?
One thing I'm looking at this, and I actually I commented back on on the proposed interagency guidance. And looking at our graphic here, that line between contract management and ongoing monitoring, one of my consulting friends brought up and said, one thing that we really need to consider, and I comment on it, is between contract management and ongoing monitoring. And Mike, I think we might have discussed too, is actually how do you onboard? I mean, we've got offboarding a vendor. What's the process to onboard your vendor as well? So just want to bring that up. I thought that was very interesting. It's kind of that gray state between contract management and ongoing monitoring. The other thing to bring up, I think is very important, is your slice of the pie here for people, skills, and training. We all understand third-party risk management well as being risk professionals, but how well do the frontline staff understand third-party risk management? And I bring that up because I had a review with a pretty large bank client. It's a mid-sized bank. And we were talking to the person assigned to third-party risk management and saying about, well, what do you do to assess the risk? And he said, well, we rely upon the third party to manage that, those risk activities. Why do we have to do it? And so it clearly showed that a little more training was needed for that staff. So
yeah,
that's
a good point. I think reporting too, John, also technology comes up, the question about technology and enablement. There are systems out there, they call them GRC, governance, risk, compliance, technology tools. A lot of great ones out there. What I always tell clients is that you got to be ready you have to have readiness for technology enablement. So managing on spreadsheets really, quite frankly, isn't bad if your program is new. Once you get evolved and mature, then you can start looking into the business requirements to have a technology solution. What I see oftentimes is that a lot of firms get sold by these GRC providers. They're great salesmen. They're going to tell you the tool can do everything. Well, not really the case. We use the term, John, right? And this is a colloquial term we use, garbage in, garbage out. So if you don't have the right framework, processes, tools in place, it can be very damaging to put a technology solution, which is going to take, quite frankly, 3, 6, 9 months to implement across your organization. I say have the process, the framework mature first, even if it's on spreadsheets, if it's on Word documents, as long as we can be well managed. Obviously you want to have a contract repository. You don't want to have contracts in your desk drawer, but you got to have, obviously having a SharePoint tool is okay for the beginning, but to go to those big solutions that are going to cost a lot of money, I would say be ready first before you get there. Take your time. I see too many organizations sign the contract, they buy all the modules, and then they have to figure it out later. Right, John? I think those GRC nightmares, I could write a book. I could write 2 books on a lot of organizational nightmares from buying tools, and they try to roll it out, and it just failed completely. Not because of the tool, because they weren't ready. A lot of these tools are really great. You got the Gartner quadrant and tell you they can do this, reporting, due diligence, but again, the organization has to be ready for it.
And that brings up a good point. It's just, in our role and asked by clients, can you do a maturity analysis? And I think that moves right into our next polling question, Mike.
Yeah. How would you assess the maturity of third party? It's a trick question, by the way. How would you assess the maturity of TPRM program in your organization? Obviously, could be A, weak, partially developed, C, meets regulatory expectations, and D, exceeds expectations and fully mature. We'll get everybody up 30 seconds or so. I want to see if anybody has D. I want to see that one, but there might be a few. Typically, when John and I do these maturity assessments, everybody says, we're great, we're the best, Rolls Royce. All right, 13% are in that category, fully mature. 33% meets regulatory expectations and partially developed, 38%. And weak, 16%. So that's pretty much what I expected to see. So again, when
that looks realistic, doesn't it?
Does, absolutely. So, well, we'll go to the next slide. And I think, obviously this is the end-to-end life cycle. And obviously leveraging the OCC model, but again, end to end, you can't treat third-party risk management in silos. You have to look at it from planning, due diligence, risk assessments, contracting. Obviously, governance really is overarching to me, and then monitoring, reporting, offboarding, exit strategy, contract termination procedures. But I think a lot of organizations sometimes fail to have an end-to-end model, and procurement is something that I get a lot of questions about. Where does procurement fit into that? And John, do you want to take that question? Because I know someone's going to ask that question about, hey, we have a procurement function. Where does that sit in the organization? And I'm not suggesting that risk management owns procurement, but I think procurement is obviously part of third-party risk management.
Oh, definitely. Definitely, Mike. I mean, I'm dealing with clients and actually had discussions when we did the RMA response to interagency guidance, that we had procurement professionals engaged, fully engaged with us as we provided the response. It just naturally goes hand in hand with just overall third-party risk management. The one thing I'll bring up about this is in the planning aspect, that really is critical. And one of the things, in fact, Mike and I were discussing this morning about just, are you accurately identifying the risk of the activity? Because that really sets the roadmap on how you're going to manage third-party risk, how you're going to manage your vendor. You got to get that right. If you're not properly identifying either a critical risk activity, or you're really putting too much emphasis on an activity that really would be more of a medium or moderate activity, you could be ending up really improperly using your resources.
Right. Well, that tiering methodology, John, too, is like a lot of firms have 4-tier, seen 3-tier, I've seen 5-tier. We've seen different tiering methodologies. It has to have a good methodology that accurately captures those critical vendors and also strategic vendors. You may have some vendors that don't fall into that category of criticality in terms of your quantitative assessment, check the box, and all these questions, but it's strategic to your organization. And I would put those in that first tier as well, as from a critical perspective. So I think the tiering methodology is always going to be subjectivity, and you got to have that qualitative override, as I call it. And so you could have a great quantitative scoring system and come up with a score. Sometimes things are not going to fall into that category. So one thing I'll say, if you have consumer-facing vendors in your organization, that should fall in your critical category, because you've heard of an acronym called the CFPB, and they're a regulatory body. And if they consumer-facing vendors, whether they're direct or indirect, are critical to an organization. So I've always coached, third-party risk management functions. When you have offshore vendors, subcontractors, when you have or third party with subcontractors or consumer-facing vendors, they're not in that first tier, that critical tier, then you better kind of do a qualitative override. I don't know if, John, you've had the same experience with some of your clients, but I know I've did it quite a lot, because I've seen 100 different methodologies. There's no one size fits all, but to me, some things should come up in that first bubble.
Yeah, I've seen it too, where in an organization where people might have the perception that their activity that they rate, they believe it's a higher critical risk. Well, in actuality, it may be more of a moderate risk. And it was kind of funny how we had people getting upset because they thought their activity was higher risk than what it actually came out to be. So it is what it is. But in my experience, I was with a mega bank for a while regarding the number of critical activities that we had in our organization. It came down to 5. And I think the industry rule of thumb is you shouldn't have a large volume of critical activity providers in your organization.
Yeah, it's a tough line. I think, that's you always try to balance things, but you can't do kind of like you've seen in school, a curve. Everybody had a curve in school, A, B, C. Very hard to do that, stratifying your vendors in that, but you obviously have to have some good objective criteria on how you do your initial onboarding. One thing I'll also mention on the last slide, if we can go back to reporting key risk indicators, you should be having good reporting dashboard metrics. There could be KPIs, key productivity indicators, but also good key risk indicators that are kind of predictive and telling you if you're missing things across the way on onboarding, or if you have, and that I think for an organization, it has to be driven from the first line of defense, and you should have the second line as well. So that would be one thing when I look at key risk indicator reporting. Definitely should capture third party. I would say oftentimes I just don't see enough good metrics being reported at ERMC, enterprise risk management committees, board risk committees. For some reason, third party risk is always on that number one, number two risk list, but then you don't see the reporting behind it. So there has to be good monitoring, reporting, and oversight. And obviously governance, we talked a lot about that, includes making sure there's oversight and reporting from the first line as well that bubbles up. So it should be bottom up and top down. You got board oversight, and you should have the first line feeding you the metrics from the bottom up as well, from their perspective, the relationship owners and the contract owners. That relationship between the relationship owners and your vendor management, third-party risk management office should be very well cohesive. If it's not, you can have problems. It's very difficult, the cultural challenges, and I could talk for 2 more hours on culture. Culture in the organization regarding third-party relationships has to be there. It is very difficult to have contract relationship owners. They have a day-to-day job, right? They're doing whatever business role they have, and you're giving them another job to do, and they're not getting paid for it. So it's going to be a little bit of a cultural resistance with somebody giving somebody a job that they're not getting paid 2 paychecks for. So you have to really incentivize those third-party relationship contract owners, and that's something that every organization has to find out. Whether it's money, maybe give them some kind of like something at whatever, pat on the back, but there's got to be something to incentivize these relationship contract owners to do their job effectively. Otherwise, you could have the great framework in place, second line, great policies, procedures, but really operationally, it's not working effectively. So we can go to the next slide. Again, need for effective third-party risk management. We talked a lot about increased reliance that's been going on third parties. Geographically as well, a lot of offshore vendors, integration of third parties into operational processes that impact customers, even consumer-facing vendors. We got into that CFPB topic in the last couple slides. Again, increased consumer protection regulatory requirements. So it's really a cross-functional activity. You got to look at the risk profiles, risk appetite, and determine the optimal organizational model supporting third-party risk management. And that takes a lot of time to do. You got to really look at your organization. Again, it's no one size fits all. You got to make sure that obviously the operating model, roles and responsibilities, checks and balances, first line ownership and accountability are working very well together. Internal audit as well has a role to play. I've done a lot of these presentations for internal audit, telling them what their role is in the third-party risk management program. So you have to have some good integration with the procurement, the sourcing strategy, a lot of facets of the program. That's why I believe a centralized office in the second line is key, and it should be staffed accordingly. I see too many times one person is staffed with managing all the third-party risk management relationships in the second line. Not very good. You need to have a little more of a resourcing model to support the work that takes a lot of time to do if you're doing it properly. Anything to add, John, on that?
I think, yeah, just to bring up a point, I'll just throw that in there, is the discussion about the 1.5 lines of defense, and that is really having effective, knowledgeable vendor managers that are assigned to each third party. Really is important. One thing that I've learned over time is you have to have an individual assigned to oversee it, not a committee. You have to have an actual person, and that person has to be knowledgeable, because in fact, not only to manage the relationship, but also to provide their expertise to the first line, to really act as a mentor or trainer as well, so that they understand why things are done within the organization. Why do we have to have this process? And that's where a good vendor manager will be able to tell like it is to the business lines what the importance is of that risk.
Yeah, I use the term again, effective, strong is what we've heard that term, right, John? We've heard the term strong risk management, but effective for me definitely means sustainable model, right? It can't be that regulatory. It has to have the value proposition of doing good, effective third-party risk management. It can't be just designed as a regulatory check the box exercise. It's got to have sustainability. And if you don't have sustainability, it's going to fail. It's going to be something smoke and mirrors. You're going to be trying to prove to everybody that you got a great program, but really it's not really working effectively. And that's why scorecarding to me is very key from a validation and verification standpoint. You need to scorecard those relationship contract owners. They're not all going to fit into the A+ category. If you're going to look and give an exam, and are they doing their role effectively, you're going to find some are doing it really well, some are not, and you got to call out those outliers and get them in line. Same thing with effective enterprise risk management. If you're looking at having an ERM program in the second line, you have all these business units that have their ERM programs. You're going to have some in the first line business units that do it well, and others are not. They just don't care about it because they're making money. They're revenue generating businesses. They don't care about risk management. They care about making money, and risk management comes later. You got to call it out to the ERM board risk committees. If you're not doing that, got a problem. Another busy slide here, but really what we're talking about here is, again, a point we said earlier, excuse me, customizing the third-party risk management program based on the risk. And John makes that point every time I hear him speak. He will speak about you got to make it the program based on you got to right size it to your institution. John helped write the guidance, right? The OCC guidance, right? You wrote that, but it can't take it literally. Go ahead, John.
Yeah, and that's, I think, Mike, you hit the nail on the head. You have to design it based on, your available level of resources as well, in your organization. One question I always received when I was still at the OCC is, well, should I have, so many people running this, and do I need to have this, do I need to have that, and the standard response that we had is, well, it depends on your organization. What's the size, complexity? You can't cover everything, so you're going to have to do a risk-based approach to cover third-party risk. And the focus would be on your critical providers. Which providers out there, if they fail, what would be the effect on your firm? And you definitely do not want to be focusing all your time on activities that really, if they fail, you can pick it up in-house or find another third party to pick it up. You want to focus on those activities that could have an adverse impact on your organization. That's where you need to focus your resources.
Yeah, great, John. Good point. And again, customize your approach to size and complexity. Also, make sure to risk assess the third-party outsourced activity, which John said earlier. You got to look at the activity as much as the third party, right? I think that approach is really critical. So we can go to the next slide. I also want to make one point. Last point is reputational risk. Got to think about reputational risk when you deal with third parties, because again, you own the risk that third party blows up. You own the reputational risk impact of it, not them. So transformation benefits of a third-party risk management program. Always like to, first of all, one thing I'll say is the inventory of third parties, again, is key. Categorizing them accordingly. You need to have risk ranking, tiering methodology, performance management, ongoing monitoring, roles and responsibilities, and really aligning third-party risk management with your sourcing strategy, procurement function, and again, that board reporting and KRIs. So I do think like these points here about the first one is clear understanding of which third parties you do business with, like know your customer, KYC when it comes to compliance. Same thing here. You want to risk rank your services accordingly with the criticality there, risk-based approach, ongoing monitoring post-contract. And this is like the top 10 David Letterman list of the benefits of a mature third-party risk management program. But again, you want to really look and make sure you have a good operating model, good, clear roles, responsibilities. You want to have a greater use of technology, automation. You don't want to rely too much on manual processes. But again, as I said earlier, be very careful when you look to bring on a big GRC solution to manage your third parties. You have to have a readiness assessment, define your business requirements first and foremost. But again, you want to have a sustainable approach. The last point is having that sustainable approach to board reporting, a comprehensive view for the board of critical third parties. What is your strategy, trends, and issues? Anything there, John, you want to add?
I think it's pretty good. One other benefit, it's kind of a side benefit, but a lot of cases, firm will contract a third party because of the third party's expertise to conduct that activity. Versus you don't have somebody within the firm to really manage it. They have a good overview of the activity, but they really don't know how to run it. But one of the side benefits is an individual within your firm can pick up on that and actually learn from the third party, which that gets into resiliency as well. That if you've got somebody that's dealing closely with a third party, they really start to get involved in it, understand the concepts, understand the compliance factors, and that you actually are really having an internal benefit where people are expanding their knowledge as
Correct.
well.
Good point. Well, time for the next poll. I think we're on poll number 3. And this is for the internal audit professionals, but also in your organization. How often do you audit your third-party risk management program end to end, not just a silo approach, but end to end? Is it once a year, every other year, every 3 years, or other? Give it 30 seconds or so. If you have other, feel free to enter that there as well, if you can, because we're curious ourselves. All righty, looks like I'm very, very disappointed in this answer. I got to be honest. Once a year, 27%. I expect a little bit better on that. Every other year, 12. Every 3 years, 14, and other 47. So I would like to see some of the responses on that, but I would definitely recommend, in my humble opinion, that once a year, if your internal audit function, this should be really scoring pretty high on your audit risk assessment process. But that's something we can talk about. Well, benchmarking categories, if you are doing an internal audit assessment or a framework assessment, these are the areas we would typically say to cover in your audit program or your maturity assessment, looking at policies, governance, looking at that top-down executive ownership, sponsorship, alignment with strategy, your overall strategy, strategic planning, risk appetite should be aligned. Talk about the hub and spokes model, my favorite acronym from 22 plus years ago at Credit Suisse. We talked about having a hub and spokes model in place. So we were able to have that alignment where everyone knew their roles and responsibilities very clearly, and it worked very well. Having board, executive, and business unit committees, again, policy governance has to be there. Then back to strategy. Does it align with regulatory expectations? Do you have a common taxonomy, common language and approach? Clearly defined roles and responsibilities, which I think we beat up to death in the last 40 minutes. Organizational structure. I think it's key to have the organizational structure in place. There's no one size fits all, but you got to have risk management involved in it. And if risk management is not involved in it, then I would suggest that you need to realign that structure. You need to have good culture. Culture could be a whole nother topic around culture in the organization, how to improve that. Incident response capabilities. If there's a third-party incident, there really should be a lot of root cause analysis done to make sure it doesn't happen a second or a third time. Having consistent, complete risk assessments, not incomplete, but complete. Technology, we could talk a lot about that. Cyber, vulnerability, threat detection, security event monitoring, targeted risk assessment, the whole IT piece. IT is really critical to have involved. Your cyber folks need to be very engaged in the program on the front end, not the back end. And last but not least, the process to mature the due diligence, ongoing monitoring, reporting to leadership, and monitoring activities based on risk ratings. So anything from that I missed, John? Because I mean, I said a lot. So.
I think right in the middle, the key thing that I always look at is just really the strong culture and executive sponsorship. That's really where it comes down to the key success factor. You have to have that culture, that ingrained culture in the organization, that they understand why the bank, why the firm needs to have an effective third-party risk management program.
Correct. We can go to the next slide. I think this next slide really covers some of the same topics. Again, third-party oversight management, regulatory risk. So we're talking about all the risks we have here. Regulatory, there's reputational, which is not on the slide, but I would like to say that reputational risk is overarching, of course, but from regulatory risk, you want to look at, is there evidence of third-party risks that have materialized, reputational issues or financial issues? How do you track it? Do you have an issues reporting tracking process? A lot of organizations don't track those issues. They're kind of in emails. They don't have a repository, a SharePoint, or some kind of mechanism contract compliance, those contracts really have to be looked at. Do you have a repository? I work with a couple of clients where literally they had contracts in their desk drawer. They lost contracts from 15, 20 years ago, and internal audit sampled, I don't know, 3 out of 10 that they couldn't find the contracts. Very scary. How well are SLAs managed? So again, back to contract compliance, that's very critical. Business continuity, I can't overstate the business continuity should be a lot of questions, gating questions, I call them, in those due diligence onboarding questionnaires to make sure, are there vendors in which a client depends on for business continuity? And I think there's a lot of questions relating to that. If business continuity checks out bad, you got to be very, very careful on that. And talked a little bit about concentration risk as well. You got to make sure there's good contingency planning. Over reliance on one vendor for critical services is definitely a big concentration risk. You need to have contingency planning in place. So, anything to add, John, before we move to the next polling question?
You covered it well.
Okay. Well, we're up to polling question number 4, and it's a trick question again, because John's going to talk a little bit about the interagency proposed guidance that's been out there since 2021. Are you aware of it? And if you're in a financial institution, are you aware of its impact on your organization? Either check yes or no. There's no third choice there.
To that third choice, kind of.
Yeah. I'm sure some people are Googling it right now. So maybe they've been aware in the last 20 seconds. Few more seconds. Looks like 71% said no. So the next slide, talk a little bit about.
Yeah, and that doesn't, yeah, Mike, that doesn't surprise me because, I mean, this came out in mid-21, July of 21, and it's still, and I've actually asked some of my network folks in the regulatory side what's going on. They say they're working on it, they just haven't come out with a firm date. But the longer it's been out there, the more people kind of forget about it.
Right. We'll talk for a couple of minutes, since I know we're going to be conscious of time, but just a little background, let John chime in on some of his, he's obviously been very active in lobbying through RMA and other organizations to really help banks really adhere to the guidance. So really that OCC 2013-29 was the gold standard of interagency regulatory guidance. Thanks to John. I'm going to give him a pat on the back for that. The Federal Reserve and a lot of other, obviously, they really used it as the gold standard, adopted it. FFIE CIT examination handbook has a section on technology service providers. Well, CFPB, we talked about, has their standard as well in consumer-facing vendors. And really the guidance offered a framework on sound risk management principles. We talked about the planning life cycle, the end-to-end planning, due diligence. And again, as John said, you got to take into account the level of risk, complexity, and size of your organization. And the proposed guidance that was set out really set forth, had a lot of that nature in there, talked a little bit about subcontractors, as John referred to earlier, and was really good, is designed to replace each agency's guidance on the topic. And it's supposed to be one-stop shopping, and they're going to have FAQs, frequently answered questions, and also guidelines for community banks to conduct due diligence on fintechs as well. So, John, do you want to cover a little bit of your perspective for a few minutes, and then we'll get to the last couple slides?
Yeah, I mean, Mike, I mean, you covered it here with the interagency guidance. We said, I mean, a lot of people now have kind of put it to the side. Just be aware that when that guidance does come out, that just being a former regulator, it is a guidance, it's not a regulation, but I will pretty much, based on my experience, pretty much assure that it will be adopted into the supervisory plans for the next cycle. So it gives you maybe a little time to get through that and become knowledgeable of it, because the fact that it probably will be in the marching orders for our regulators going forward. So, and procurement, you mentioned that, I mean, this really aligns to the procurement as well. So will be very important for everyone to really get on board as fast as they can. And one of the best things you can do is keep your eyes open for webinars like this when it comes out to give you some key points. Very important. The other thing, and the last triangle there, the guidelines for community banks to conduct due diligence on financial technology firms. There are a lot of good points in there as well, and they kind of align to the regulatory guidance for third-party relationships. But if you haven't seen that, I would recommend taking a look at that, not only for financial technology firms, but they just offer some good points on overall third-party risk management.
And again, this is principle-based guidance. Next slide, I'm going to paraphrase a lot of points that John has made himself in responses that trade organizations like the RMA has made. And obviously, there's cost-benefit concerns on implementation. Again, no one-size-fits-all, and practical implementation challenges with some of the provisions that they're going to hopefully work through. The definition of the term fourth party, I think, is limited. And so obviously, John, I know there's a lot of back and forth that it's just like Congress. That when you have a guidance, you go negotiate and try to get some, some common ground so banks can actually adhere to the guidance.
Right. And even, like I say, even though it's a guidance, for the regulated firms that are listening today, the examiners are not to have a matter requiring attention, anything like that, based on the guidance. However, they can point to specific regulations, and especially a safety and soundness reg. So they can find a way. So you should be fully prepared to, map the guidance to your operations and really look for those gaps now. The fourth party term, I'm going to be very interested to see how that comes out. I don't know if that may be the sticking point for the Interagency guidance. I don't know, but I know that in the proposal, there was some language regarding how to expand the third party life cycle to fourth parties as well.
Yeah. Good points. Well, our last slide is really back for effective third-party risk management. Well-designed programs should include, again, good third-party oversight, monitoring, testing. You've heard the term QA, QC. I would definitely recommend the larger banks, especially, to have those programs in place. Again, contractual language we talked about is no longer just sufficient. You got to make sure that third parties are in compliance. We talked about regulators always say you can outsource the activity, cannot outsource the risk. And contract terms, SLAs need to have key triggers that facilitate contract termination. So performance management needs to be really in place, and definitely have some obviously contingency planning and periodic updates, good reporting as well on the quality and accuracy of the third parties monitoring and testing programs. So we are going to look to see if there's any questions. If not, we'll hand it over to Scott to wrap up.
Yeah, Mike, I didn't see any questions in the chat. So I appreciate that. Great insight. You have our contact information here on the screen. This concludes our 5th session of the series. Thanks again for joining us. Thanks, Mike and John, for your insights. If you have additional questions regarding today's topic, you can reach out to us at this contact information. We value your feedback, and again, remind you that as you leave the session, there will be a short survey. We'd appreciate your feedback on that. And just as a reminder, please continue to check the registration site for the remaining session and for recordings of each session once available. The next one will be Tuesday, December 13 at noon Eastern, and will be on year-end tax planning. Thanks, everyone.